Hey everybody, what's going on? It's James here, and in this video, we're going to talk about key to becoming a successful trader. And I'm going to give you some examples. I'm going to talk about some stuff that very rarely are you going to see people talk about, which is a bit ironic because today's topic is literally what makes the difference between a successful trader and someone who never finds success in the market. So the first thing I will say is this: you need a very minimal amount of skills to be successful as a trader. I know that a lot of people who, do YouTube videos or are on social media and all these things, they love to make it sound complicated. They love to make it sound tough because then they get to be smart and, pat themselves on the back and all this. But the reality is anybody can learn enough technical analysis in a few weeks to be a successful trader. That's all the technical analysis you need to know. And now there's more advanced technical analysis, but the reality is this: if you can look at a chart and you can determine the trend and you can draw a few lines and you understand math, basic math, that's the skill set you need to be successful as a trader. So the question then becomes, well, if that's all it takes, why do most people fail at trading? And there's a couple answers to that. First answer is, a lot of people never actually learn how to trade. They will call themselves traders. They might actually buy and sell some stocks here and there or some cryptocurrency. They might have been involved for 5 years or 10 years or 15 years. Well, I've been in the market for 15 years. Okay, well, I built a doghouse 20 years ago. It doesn't mean that I'm a carpenter. If I spent the last 20 years doing carpentry every day, then I would be a carpenter. Building a doghouse, building a bookshelf, building a few mining rigs does not make me a carpenter. Just like looking at charts once in a while for 10 or 15 years or happening to own some stock for 15 years does not make you a trader. You need to first learn technical analysis or fundamental analysis. That's your bag. It's not mine. But if you're a technical trader, you need to learn technical analysis, which takes a few weeks of dedicated learning. If you don't have as much time, it might take you a few months or even 6 months. If you only have maybe an hour a week, maybe it's going to take you 6 months. So that's the first thing. A lot of people just never actually learn to trade. They're happy to sit on social media and wait for some guy to come out with a YouTube video that says, this is what the market's going to do, or this is what I think the market's going to do. And then they just go off of that. And the irony is I'm a guy on YouTube. And I'm going to be the first one to tell you, probably not the first one, but I'll be somebody who tells you wholeheartedly, you should never default to somebody else's opinions of the market. You should never take my opinion of the market and say it's more valuable than your opinion of the market. You should never take anybody's opinion. I don't care if they're on TV. I don't care if they have a newsletter. I don't care if they've been trading for a year. I don't care if they've been trading for 40 years. Your opinion is the only opinion that should really matter because it's your money on the line. If I say something about a market and you do something and lose money, it doesn't affect me. I mean, I would feel terrible. I don't want that to happen. But at the end of the day, my financial situation and your financial situation are totally different. My trade style and your trade style may be totally different. You may not even understand my trade style, or you don't have access to watch over the shoulder as I trade. And that's a really key thing to understand, because sometimes a trader will go on television and say, I'm bullish on this, stock, whatever it may be. And then you have the Joe Blow public say, okay, well, that famous guy was bullish. I'm going to buy this stock. Except after the TV show, maybe a couple of days later, their thesis changes and they sell that stock. Now they're out of their position, but they're not on TV anymore. So you don't know they sold their position. And now you're bag holding that thing while it drops 10, 20, 30, 50, 70, 80, 90%. And I'm not going to name anybody specific because it's not about picking on people. But, everyone makes mistakes. No one's right. The best traders in the world are still wrong a lot, okay, depending on their trade style. Anywhere from 20% for somebody that's trading in reverse risk to reward system to, if you're trading a high reward to risk system where you might make, $5 for every dollar you risk, you might be wrong 70 to 80% of the time. Okay. And unless you know their system, their thesis on the market direction doesn't really mean anything. Okay. So we're going to talk about some things that you need to understand in this video. And again, this is probably the most important part. You don't need to buy a course to learn this because it's something that really it's about you and the way that you work and the way your brain works and your personality. So there's basically two personality types. There's more, but there's two main personality types in trading. There's the nervous Nelly, okay? And you know who you are. You're the ones that get into a trade, and as soon as you see green, you're starting to think about taking profits, or you're wanting to lock your profits in. And that behavior often results in very, very small wins, okay? Instead of letting your trades hit their profit target. So that's type 1. Type 2, sorry ladies, this is just what I came up with. It rolls off the tongue a little bit. Are the traders with stones of steel, okay? And these are the traders that when they put in an order and they put in a profit target and they put in a stop loss, they adhere to those levels religiously. They do not move them without a justifiable reason for doing so. Their reason is technical based or fundamental based, not emotionally based, okay? So let's talk about these two types of traders. Again, what defines them? Well, I'm going to use this trade down here as an example, just a random trade, okay? So this trade here, let's say that we've got, let's say that Nervous Nelly wants to trade a 2-to-1 system. What they want to do in this hypothetical example is they want to go for 2R. So they want to do something like this. Or say, hey, I'm going for, turn our side back off there. Say they put their stop right here. We're not going to go into trade setup. We're just going to use this hypothetical trade. Say they put their stop down here. It's a $71 stop. So they're going to have about a $142 target. So we'll get that up there. There it is, 2-to-1. Okay, so this is what they need to happen. They need this to go up to this target to make some money. Okay, so what Nervous Nelly will often do is they're long here, and the next day it doesn't pop. It goes down a little bit even. They start to second guess this trade. And so rather than staying in the trade and waiting for it to either hit their profit target up here or hit their stop loss, Nervous Nelly says, I changed my mind, I'll find a better trade later. And they close it. In this case, maybe for a tiny loss. Okay. And then a few days later, bam, it's hit the target. And Nervous Nelly is like, oh, if only I would have left that trade alone. Okay. That's Nervous Nelly. Okay. Enough with the RSI. Stones of Steel, on the other hand, may say, hey, I'm not trading a 2-to-1 system. I believe this is a breakout. I believe that it's breaking above this resistance back here. And I think we're going to see a move. A big move. And so what I'm going to do is I'm not going to have a profit target at all. And you might be thinking to yourself, what? No profit target? No profit target. There's more than two systems. I'm just using these as examples. So, they might set the same stop loss, 1.61%. They might take their position, but rather than setting an arbitrary profit target, what Stones of Steel might do is he or she may say, hey, I'm going to wait until I see this thing break bullish structure. So here it is, just moving up, consolidating sideways, no bearishness yet. Moving up, consolidating sideways, still no bearishness yet. Moving up, come back down with the pivot, moving up. And so now Stones of Steel is still in this trade. Stones of Steel is currently up roughly 8.5 R. Now, the reason this is tough is because sometimes it works out perfectly, like in this example where it just goes up, 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 or consolidates, no real pullbacks that are super scary. But a lot of trades, what will happen is this will go up like this, and they'll be up 1R, maybe 2R, and then it'll have a big move down, and it'll actually stop them out, and they'll lose money. They'll get all those profits back. Now, when that happens to Stones of Steel, they're like, yeah, that's fine. My system, it accounts for that. My wins are so big that it's okay that I lose more often. Nervous Nelly sees that and says, yep, that's why I'm locking in profits. I'm never doing that because I'll have to lock in profits. I don't want to be up $100 and then lose $100. I don't want to be up $200 and then lose $100, so on and so forth. Okay. And typically, just as a side note, we're not teaching exact trade strategies, but as a side note, the Stones of Steel trader would be moving their stops. So for example, here after consolidating them broke north, they'd probably move their stop to the bottom of this range. And then when it ranged through here and then broke north, they'd probably move their stop to the bottom of this range. And so they would be protecting those profits, not just, oh, I don't care about profits at all, but they wouldn't be protecting them like way back here just because it didn't go up the very next day. And over here, after it pivoted, they'd probably move their stop to here. And at this point, they'd probably have a trailing stop, depending on their trade stop, around this level. So worst case, if this pulls back, this trader might make 6R. Okay. I say worst case, but there's always that weird thing where this, for some odd reason, gaps down. But this is the SPX here. I had the hiccups. I apologize. This is the SPX. So very unlikely you're going to have a huge gap down in the SPX. So that's the difference in these two traders. And again, I'm not talking specific trade styles or trade systems because everybody's a little bit different systems. Some people are going for 2R. Some people are going for 3R. Some people are going for 5R. Some people are going for, no specific R. They're just going to ride it as far as they can, like I just showed. There's all these different systems. But the problem is people want to get the maximum reward, and they think there's a way to do that on every trade. They think there's a way to know which trade you should do just 2R or -1, and which trade should be 5R and -1, and which trade you should ride. And the thing is, those things in hindsight. In hindsight, we can say, hey, this basically went straight up and I could have just rode it. In real life, in the moment, we would not have known it was going to do that. And so somebody who took a 2R would not be wrong for doing so if that was their trade plan. If their trade plan calls for them to take 2R or take a 1R loss, that's what they should do every single time, because that consistency is how you get results. Because when you're consistent, then you know your math, okay? This is what I say when you need to know basic math. If I'm trading 2R, and I've talked about this many times in the past. In fact, let me get text out here so it's not ugly jars. If I'm trading a 2R system, what that means is I'm risking $1 to make $2, okay? Which means that, let's say hypothetically, I'm wrong 60% of the time and right 40% of the time. Let's say over 100 trades for easy math. That's going to be 40 wins, 60 losses. What's 40 wins times $2 per win? That's $80. What's 60 losses times $1 per loss? It's $60 loss, which means after those trades, this trader will be up $20 per dollar risked. And you just extrapolate that out. Of course, if you're risking $1,000, then you would be up $20,000 after those trades. If you're risking $100, then you would be up $2,000. If you're risking $10, then you would be up $200, so on and so forth. Okay? That's how that works. Once you know your math, you're golden. All you have to do is stick to the system. That's all you have to do. But people don't stick to the system. Most people do not fall into the stones of steel. Very few people start out in that camp. I would say 90% or more of traders start out in the nervous Nelly camp. And so they will take the same exact trades as this trader with the exact same reward to risk and the exact same everything, except maybe they're closing their winners a little bit too soon. So instead of making $2, they make $1.50. Now let's say you got 40 winners times $1.50. Well, that's $60. And let's say that they don't take their stops, so they let those 60 losers run a little longer. So instead of losing $1, they lose $1.50. So now they're losing $90, which means after those same 100 trades, they lose $30 per dollar risk instead of making $20. It can be the exact same trades, but that nervousness, that fear takes them out, and that's what causes them to become a losing trader. And then they bounce around looking for the perfect system that guarantees that, they know when to get out, they know when to do this, they know when to do that. And the reality is the biggest step that you can take toward becoming successful is to just fully accept that you have control over the action you take, but you have no control over the results of the trade. And what I mean by that is once you're in a trade, if it's a justifiable, good trade, you have no way to control whether that becomes a winning trade or a losing trade. You can't control what the market is going to do. You have to release control and accept that sometimes you're going to lose. Sometimes you're going to take a wonderful trade where you do everything exactly the way it's supposed to be done, and you're going to lose money. And that is the nature of this business. And if you can't handle that, you're going to have a very difficult time ever becoming a proficient trader. If you can handle that, you can unlock the kingdom, right? You can have the keys to the kingdom, as they say, because again, the technical side of this is something that is very easy to learn. I often joke that when people say, what do I do for a living? I tell them I draw lines on a chart, because that's all it takes. Now, in this case, this is one of my indicators called Trend Titan, putting these labels on here. But if I didn't have an indicator, I could still trade. I could see trend lines and things. Like if I was watching this chart with my eyeballs, I could clearly see that this was a range down here. Not a perfect double bottom by any means, but if it's breaking this midpoint over here, I can clearly see with my eye that that was a potential trade spot. I wouldn't have to have an indicator. The indicator just makes it a little bit easier because it sends me an alert, and I know, like, hey, I want to go check this chart and see if it's legit or not. Saves me a bunch of time, helps to keep me from missing trades. Okay. But same thing over here. There's these signals over here, and that's all fine and dandy. But if I was looking at this with my eyeballs, I could also just try to draw trend lines. Like, for example, look at this. Maybe I could look for a trade in this area over here because it's coming down in the trend line. Or maybe this pulled back further. I could have looked for a trade at the top of this range, but it pulled back to this area, so on and so forth. Again, indicators are very helpful. They save a ton of time. They help to, help me find more opportunities. But I'm by no means saying you have to have indicators in order to be successful. You have to have a system, and then you have to have the courage to stick to that system. And the last thing I'm going to mention before I wrap this up is, if you're a brand new trader, and by brand new, I don't mean the length of time you've been in the market. I mean, if you're somebody who's not consistently making profit trading, you should not be trading with full risk. I don't care if you've got $50,000, $10,000, $100,000, $500,000. I don't care how much money you have, right? There's no way that you should be risking more than $5 or $10 per trade until you've proven that you're actually a profitable trader. Because then you're not focused on learning, you're focused on the money aspect. And the more money you're risking, the more nervous you're going to be and the more mistakes you're going to make. If you trade with $5 or $10 risk, and after months you're like, wow, I've made, 10R, then you can say, hey, next month I'm going to up my risk some, because I've shown the system actually does work. And the next month, maybe you risk $25 per trade. And then if you have a profitable month, or if you take good trades and you stick to the system, because you're not always going to have profitable months. Sometimes you're doing everything right and have a bad month. But if you stick to the system, you don't close trades early, you do everything you're supposed to do, then maybe month 3, you say, okay, I'm going to bump this up to $50 risk per trade. And you do that until you're at a point where you're risking about 1% of your account per trade, all the way up to 3% per trade, depending on your risk management style, depending on your risk tolerance. Those are the general rules of thumb that most traders live by. 1 to 3% of account size per trade. And again, not going to go too deep into this, but doesn't mean if you've got a $100,000 account, doesn't mean you buy $3,000 worth of stock. That's not what it means. What it means is you risk $3,000. So if you're wrong, you lose $3,000 in that trade. If you're risking 3%, or if you're doing 1%, if you're wrong, you lose $1,000, and so on and so forth. And if you do it that way, let's just say, as a conservative number, maybe you're making 10R, which is 10 times your risk per month. Well, if you're risking, again, for easy math, say you're risking $1,000 per trade, 10R would be $10,000 a month. After 12 months, if you're making 10R each month, you'd have 120R. It's $120,000 on $1,000 risk. Risking $100, 120R would be $12,000, so on and so forth. Okay. But the reason people fail is it's very seldom a lack of knowledge. It's almost always an emotional problem. After you get, again, that initial foundation set up. If you don't know technical analysis, then you shouldn't be trading. That's a bold statement, but it's just a fact. Even people who trade fundamentals tend to know technical analysis, and they tend to have a little bit of technical analysis involved in their trading decisions. So step 1 is to learn how to read charts and how, actually apply technical analysis to a chart. Again, it's something that can be learned, in a few dozen hours, really. I mean, actual study, like maybe 50 to 100 hours of actual, applying yourself and learning the candlestick patterns and what this means and what that means, what a range is, how to identify a trend, all that kind of stuff. After that, it's emotional. It's absolutely emotional. It's sticking to your profit targets. It's sticking to your stop loss. And it's deciding what type of trader you are. Are you a trader that's going to be a trend trader where you ride those trades for maximum gain, understanding you're going to lose more often, understanding you're going to sometimes take winners that turn into losers? Or are you going to be the person that wants to say, you know what, I'm going to do a tried and true 2-1, 3-1, 4-1, 5-1, whatever it is, right? It's either going to be a profit at 2R, going to be a loss at 1R, period. No ifs, ands, or buts about it. I'm not going to be the guy that goes in there and has a 2R target and a 1R stop, and I change my stop 5 minutes after I'm in the trade because I'm scared to lose money. That guy's always going to struggle. All right? All that being said, please remember, I am some guy sitting in a spare bedroom, which means that nothing in this video is financial advice. You should always go out and do your own due diligence and seek out professional financial advice from a licensed financial advisor for making any type of investment in cryptocurrency, the stock market, precious metals, Forex, or any other tradable asset. If you enjoyed this video, please stop now, give it a thumbs up, subscribe to the channel, and of course, don't forget to leave me a comment. Comments help tremendously with the crazy social media algorithms. All right, this is James with Crypto Common Sense, reminding everybody to please trade safe, and I'll talk to you soon.